This video explains the garage technique of accounting for the FIFO and LIFO methods of costing inventory, as well as the T-account technique of accounting for the weighted average method. Here are the data we will use for this demonstration. Note the $8,200 of goods available for sale. Here we will calculate the cost of goods sold and ending inventory using the FIFO method. We draw a garage for each batch of goods that was purchased. For this example, we have 3 garages, one for beginning inventory, one for the January 12th purchase, and one for the January 19th purchase. Inside each garage, we put the number of units purchased, the unit price, and the total cost of the purchase. We also write the date of each sale in relation to the purchases. The January 17th sale is after the January 12th purchase, and the January 26th sale is after the January 19th purchase. We also write in the total units sold for each sale. Our mission is to determine the cost of the goods sold for each of these sales. FIFO stands for first in, first out, so we would sell the 20 units in beginning inventory in the first sale on January 17th. But we need another 30 units to complete the 50-unit sale, so we get those units from the second garage or the January 12th purchase. That leaves 30 units in the second garage. Then we add up the 2 batches to get the cost of goods sold for the January 17th sale. Now we turn to the January 26th sale of 32 units. Since we have 30 units left in garage 2, we use them in the January 26th sale. But we need 2 more units to complete the sale, so we get them from the third garage or the January 19th purchase, which leaves 18 units in the third garage. That is ending inventory. Now we add up the 2 batches to get the cost of goods sold for the January 26th sale. It is now time to reconcile to the goods available, which is the sum of the beginning totals in each of the garages, or $8,200. The total cost of goods sold is the sum of the January 17th and the January 26th sales. The ending inventory is the 18 units in garage 3 times the $100 cost per unit, or $1,800. Now let's look at the same process, but this time we will use LIFO, or last in, first out method. We start with the same garages, purchases, and sales. Remember, we cannot sell inventory that we have not yet purchased. So when we look for the last in from the January 17th sale, we look at garage 2 or the January 12th purchase rather than garage 3 or the January 19th purchase. We can get all of the 50 units from garage 2. Now for the January 26th sale, we would look to the last in, which are in garage 3 or the January 19th purchase, to get those 20 units. But we still need 12 more units. We can get 10 units from garage 2 or the January 12th purchase, and the remaining 2 from garage 1 or beginning inventory. Then we add up the amounts to get the cost of goods sold for the January 26th sale. It is now time to reconcile the goods available that is the same amount as in the FIFO example. The cost of goods sold is the total of the January 17th and January 26th sales. Ending inventory is calculated by taking the 18 units left in garage 1 or beginning inventory by the $70 per unit. Notice that since the cost per unit is going up with each purchase, $70, then $80, and finally $100, that the cost of goods sold is higher in LIFO than it is in FIFO. Here is the setup for the T-account approach for the weighted average method. Make a big T account as shown. Remember that inventory is an asset account, and debits increase and credits decrease an asset. We are going to record the units, unit cost, and total cost for each transaction in chronological order. The first transaction is beginning inventory, which goes in as a debit. The second transaction is the July 12th purchase, which is also a debit, which adds to inventory. The third transaction is the January 17th sale of 50 units. Leave enough space to put subtotals in the debit column. We will be calculating the weighted average cost of the units in inventory just prior to the sale. Draw a line to indicate a subtotal. Then calculate a subtotal for the units and the total costs. To get the weighted average, divide the total cost by the units. Then use this number to multiply by the units sold on January 17th. Now you can record the next transaction, which is the January 19th purchase, again a debit. Next is the January 26th sale of 32 units. Again, leave enough room to calculate a new subtotal in the debit column. Draw a line to indicate a subtotal. To get the subtotals, you will have to add the balance after the January 12th purchase, subtract the January 17th sale, and add the January 19th purchase. Do this for both the units and the total costs. Now you are ready to calculate a new weighted average to use in the January 26th sale. Now draw another line to calculate the ending balance for inventory. Add the balance after the January 19th purchase and subtract the January 26th sale for both the units and the total costs. We are now ready for the reconciliation with goods available. To get the total cost of goods sold, we add up the total cost from the January 17th and January 26th sales in the credit column. Then we pull down the ending balance from the debit column and you are done. I hope this short video has helped you visually understand how the FIFO, LIFO, and weighted average methods work in determining the cost of goods sold and the ending inventory.